The goal of every trading system is to mechanize the trading process and eliminate the role of human error in trading as much as possible. However, human error can easily creep into the trading system design process, so it's important to guard against the common pitfalls associated with system development. All too often, a trading strategy looks great in a backtest, but fails to live up to that high standard when it comes to live markets. So the following list of mistakes can be used as a checklist of things to look out for during backtesting and development. This is part of the process that we follow when we create our trading systems. So let's have a look now. Number 1, no out-of-sample testing. Designing a trading system typically involves generating a hypothesis and then backtesting that idea on historical data. The data used for this is called in-sample data. There's nothing wrong with using data to train a trading model. However, it's not a good idea to evaluate the trading strategy over the same data. After several tests, you're going to come up with a profitable trading strategy, so you need to have some clean data available to evaluate your results. It's important to leave enough out-of-sample data with which to validate in-sample backtests. For example, if you use data from 2010 to 2012 to train your trading system, you should test it over 2012 onwards to validate it. If the system performs well on the unseen data, then you may have a sound strategy. It's worth bearing in mind that earlier data, for example 2006 to 2010, is not as reliable as more recent data will be, as it contains an element of look-ahead bias. In fact, out-of-sample data nearly always contains some element of look-ahead bias. For example, you probably know what has happened in the market over the last couple of years, and that could easily bias the inputs to your trading model during your in-sample testing. So the very best out-of-sample data is future unseen data or live data. Number 2, flipping between in-sample and out-of-sample. Following on from point 1, it's important to keep out-of-sample data separate from the training procedure at all times. For example, if you run a model over out-of-sample data and get poor results, don't go back into the in-sample data to refine the model based on those findings. If you do this, you contaminate the out-of-sample data and end up introducing more look-ahead bias into your strategy. It's best to run a strategy on out-of-sample data only once. Using out-of-sample results to inform in-sample modeling leads quickly to curve fitting. In general, developers should treat their datasets with the utmost care. 3. Ignoring survivorship bias. During backtesting, it's important to use data that is an accurate reflection of real trading conditions. A big problem with many data providers is that they do not include historical tickers in their datasets. This introduces survivorship bias and invalidates the trading system results. For example, consider a trading system that is backtested on 2 separate datasets between 2005 and 2010. The first dataset comes from Yahoo and is free data, and the second is a subscription service from Norgate Premium. With the first dataset, the trading system is run and it returns an average of 10% compounded per annum. But on the second dataset, the system return is only 3% per annum. So what's the difference between these 2 datasets? Well, the reason for the difference is that the free data from Yahoo does not contain any stocks that went bankrupt during the 2008 crisis, nor does it include any delisted stocks that merged or were taken over by other entities. The premium dataset includes these securities, and thus it gives us a more accurate result. Trading systems need to be built using accurate point-in-time data that is free of survivorship bias, and the data we use from Norgate Premium has been organized so as to minimize this problem. It's also been adjusted for capital events, cash dividends, and stock splits. Number 4, ignoring market regimes. Just as we need to take into account survivorship bias, we also need to be keenly aware of prevailing market conditions or market regimes in the data that we are using. Market conditions can have a tremendous effect on the performance of a trading strategy. For example, consider a backtest that is run on US stock data between March 2009 and August 2015. This recent period has seen a very strong bull market, so any strategy that involves being long stocks during this time is bound to do very well. Conversely, any short selling strategy is bound to do poorly. So it's important to test systems during different market conditions to see how they get on. Other than bull markets and bear markets, it's been suggested that there are no more than 4 market regimes: high inflation, high growth, high inflation, low growth, low inflation, high growth, and low inflation, low growth. Different assets perform differently during each regime. For example, gold and precious metals perform well in high inflation periods, stocks perform well in high growth periods, and bonds perform well in low inflation periods. The solution for system developers is to try to backtest their strategies over the different regimes to ensure they are robust to those different market conditions. Number 5, observing the close. A common error that some developers make is believing they can use close price data to compute an entry signal and then simultaneously trade at that close price. For example, a trading system might be devised to buy a stock on the close when a technical indicator crosses a certain level. However, most technical indicators are calculated using the closing price. It's not possible to trade on the close of the bar since you won't know the indicator value until after the close price is known. So this is one example of look-ahead bias that can cause huge differences to system returns. So if your entry signal is based on the close, have the system trade on the next open. Another option is to calculate your entry signals with the open price and then trade on the close. And another option is to calculate the level at which the indicator will cause an entry signal. Number 6, ignoring market impact. Another thing that is also easy to forget during system development is that historical data does not include your own system's trades. When the trading system is taken live, it's going to have a direct impact on the market itself, and under certain scenarios, it's possible that your system will move the market and it will move it unfavorably, making it unlike your simulation results. So it's important to realize the potential for the trading system to have a negative impact on the market once you take it live. And we typically suggest that traders account for market impact in their transaction costs. We typically set our transaction costs at 1 cent per share or 0.1% per trade and increase that for smaller cap stocks. Number 7, under or overestimating slippage. Following on from the previous point, we believe that some system developers misunderstand the nature of slippage, causing them to underestimate it at certain times and overestimate it at other times. In reality, slippage, or in other words, the price fill you get versus the price fill you want, is not a constant that can be modeled with 100% accuracy. Slippage varies according to the actions of market participants. So, slippage is greater during periods of market stress, in liquid markets, and it's less during periods of calm. It's a good idea to introduce different levels of slippage into your transaction costs in order to test the robustness of your strategies. Bear in mind that slippage changes during certain market conditions. Number 8, unrestricted position sizing. Imagine you have a trading system that compounds at 50% per annum. Without any restriction on position size, there's going to come a point where that trading system has generated more wealth than the entire global economy combined. This will happen after several years. This is obviously not possible in the real world because there comes a point where the system has a direct impact on the market price, and this means that the system cannot possibly keep performing at that high level. For example, it's not possible to buy $50 million worth of stock in a $100 million company without having a significant direct influence on the bid-ask price. And this explains why large investors and hedge funds are going to avoid thinly traded securities. It's important to have the backtesting software that you use limit the position size to a percentage of the daily volume. We typically recommend that position size is no more than 5% of the daily volume, and this is easily taken care of in AMI Broker settings. Number 9, overfitting the model. An overfit trading system is one that models the in-sample data so well that it's likely modeling random price noise rather than any underlying principle or any relationship or pattern in the price data. This results in a trading system that is curve fit to random data and unlikely to work in live trading. Overfitting a trading system is easily achieved in most backtesting programs where the data can be mined to your heart's content and you can add as many indicators and parameters as you wish. Parameters here are the equivalent to degrees of freedom. As the degrees of freedom increase, so does the possibility of overfitting. Base your trading system on underlying principles or market observations and refrain from continuous tweaking or refining the system in sample. Also look to compare backtest statistics such as the in-sample error with the out-of-sample error, and they shouldn't be wildly different. Number 10, ignoring non-stationarity. The principal reason why overfitting leads to losses in the first place is because financial data is dynamic, not stationary. And this is something else that needs to be understood. If financial data was static, you could come up with a trading system quite easily and it would perform just as well in live trading as in the backtest, and you'd be very quickly making a lot of money. But financial data is not stationary. It's an ever-changing, adaptive, complex system with many different participants. And this is why trading systems break down. The fact that financial data is not stationary is what makes trading so difficult. The solution is to try and tune and adapt strategies so that they move in step with the market. Of course, this is easier said than done, and it's both an art and a science. 11. Placing too much faith in complex models. It's typically the complex models that end up being the most overfit strategies. These strategies may work for a time, but end up blowing up when market conditions change or when something unexpected happens. A good example of this is the failed hedge fund long-term capital management, which utilized a fixed income arbitrage strategy developed by Nobel Prize winning scientists. The more complexity in a model, the more easily it is curve fit to the data and the harder it is to keep track of. So try to develop strategies that are based on simple logic or market observations. Avoid the temptation to program complex models or introduce too many parameters. Find strategies that are based on underlying themes, such as investor psychology. Number 12 is stateful strategy error. A stateful strategy is one where performance can vary greatly depending on the day in history it was started, as a result of the rapid accrual of portfolio holdings. For example, consider a portfolio strategy that buys stocks making new daily highs. If that strategy begins just one day later, the construction of the portfolio is likely to be completely different. When a trading strategy rapidly accrues assets and holds them for a reasonable set of time, the start date of that test can have a huge impact on results. There's nothing wrong with having a stateful strategy, but just remember to test it out with different start dates to make sure that the performance is not a fluke. 13. Data mining bias. Even if you avoid all the mistakes we've discussed, if you generate and test enough trading strategies, you're going to eventually find one that works very well in a backtest. A system may perform well in sample and out of sample, and even across different markets and with different start dates. However, even though such a strategy may seem robust, it can still be the product of data mining, and therefore it may still be a random strategy. Unfortunately, there's no real way to avoid the data mining bias completely. The best solution is to base trading systems on market principles, paper trade the system before committing too much capital, and keep alert for obvious signs of randomness. 14. Self-delusion. Perhaps the most devastating mistake on this list is the human propensity for self-delusion. When building a trading system, it's very easy to ignore the red flags and kind of become blinded in the hunt for a money-making strategy. Unfortunately, ignoring these warnings just leads to further pain down the road. So it's important to take steps to avoid this self-delusion cycle. To avoid self-delusion, undertake projects from a sound base with the right knowledge. Knowing the pitfalls, as we've discussed here, allow you to more easily see the kinds of mistakes that can creep into trading system models. When a trading system appears too good to be true, it's often because something important has been overlooked in the development process. So, when developing a system, you should question and analyze every system input, and really every line of code, which is another reason why simple models tend to be best. Evaluating different test periods, walk-forward analysis, cross-validation of systems, checking the code, checking exposure, and using common sense. These can all be used to objectively analyze a trading system. Finally, once the trading system has been created and is performing well, keep observing it and stay alert for obvious signs of breakdown. So I hope you find that list of backtesting mistakes useful. If you keep these in mind whenever you build a trading system, you're going to be a lot better off.